Well, thank you very much, Nadia, for this introduction. It's my first time here at Venture Café, and I'm also not very used to Zoom, so I'm going to give it my best to give you the first basic rules about investing. I used the beginning of the PowerPoint that I also use with students who have no idea about investing. So therefore, I start with this one, investing for dummies. A short preview about who am I, who is Ploni Koevoet-Sonneveld. Well, I used to work at a steel company, and then I changed into insurances, and I thought that was pretty boring. So therefore, I became a financial planner at the Rabobank, and that's when I learned how to invest money. And the beauty of it was that it was investing money of other people. So it wasn't my own money, it was their money. And if they made a loss, then it hurt them more than it hurted me. But at least I got to learn more about investing on the stock market. And it got my interest. So therefore, I thought, what can I do more about these things? And therefore, I started teaching. In my free time, I'm a mother of two beautiful daughters, and I have a very nice husband. And we'd like to travel and try out some different things. And I also do a mud run every now and then. So I come from a very, I'd like various things to do. But anyway, enough about me. We're here to learn more about investing. So I put together some learning objectives, so you know what we're aiming at. Well, we're aiming at the basics of investment instruments. So in what kind of instruments can you invest, and what are the specifics about it? You have to know before you start with investing. I'm also going to give you some pitfalls, or how to avoid these pitfalls, and tips on maybe how to start. Well, it's all about you and your own money. I can never decide for you what to do. But anyway, I can maybe give you some insights on how to get started. Rule number one, this is the rule I always start with. And this is the rule I also learned when I worked at the investment department of the Rabobank. Only invest with money you don't need. And money you don't need for the longer term. So not like, oh, I have some cash left for at the end of this month, and I can put it into an investment. No, that's not the way you should do it. So you should always need money you don't need for a longer term. I get back to this later on. First of all, this is the pyramid I got my my basics learned with this pyramid. There are two arrows. One is the risk and one is the return. The higher you get into the pyramid, the higher the risk of losing your money, but also the higher the risk of getting a higher return. Yeah. So therefore, I put them in a little order, so you know what kind of risks and returns are in the different investment categories. Well, the first one is about liquid assets. Well, if you have spare money left now, you put it in the bank, and they probably give you some interest. However, the interest rate is very low at this moment, and therefore more and more people get interested in the other segments above these liquid assets. The second one in line, when you look at the risk and return, are bonds. And a lot of people think that bonds are only bonds that you from a government, but you can also a company can also issue a bond. What is a bond? Well, they used to look like this, like the state of South Carolina. I don't know if you can read it. The state of South Carolina needed money, and therefore they went to the people, but nobody could afford this big amount of loan. Nobody can lend them that money at once. So therefore they cut up these big loans into smaller pieces, and they sold those pieces. So when you put it into words, a bond is an IOU. I owe you something. So in this case, the state of South Carolina owed you an amount of $1,000. Do you get something in return? Well, most of the time, when the bank lends you a little bit of money, you have to pay interest. So when you lend money to somebody else, in this case, the state of South Carolina, you obviously want something in return as well. And that's the coupon rate. So, and these are those little coupons they used to have. Now everything is digital, but sometimes the old-fashioned way shows a little bit more how it really worked. So every year you went to the bank or to the state of South Carolina and you said, I lend you $1,000. I come here for my coupon. I would like to get my interest paid out. And then they cut off that little coupon and gave you that money. So they knew that they had paid it out. So the distinguishing figures of these bonds are that there's a nominal value. The loan is initially $1,000. So in the end, in this case, they will pay you back $1,000. In the meantime, you get a coupon. That's the interest rate. And the interest rate is normally fixed. So you know, for a longer term, you get a fixed rate. You also know that the maturity date, by the end, they are going to pay you back. What are they going to pay you back? Well, the nominal value. Depending on the strength of the company, they will give you a higher or lower interest rate. To give you an example, in 2008, when we had the financial crisis, Greece was in a very sad situation. They needed money, so they issued bonds so the people could actually help the Greek government with a loan. And the interest rate on that loan was 60%. So that was a very nice amount of interest rate. If you invest 1,000 and you get 60% interest a year, that's a very good thing. However, the company itself, in this case, the government of Greece, wasn't a really strong government. So therefore, there was always a risk that they would not pay you back. And we call that, the strength of the company. It also always depends on a kind of rating. Yeah, maybe you've seen these ratings before. A AAA rating, you heard it before. AAA is the best there is. They don't only use that for bonds, they also use it for private companies, for shares, to say, well, this is a very solid company. It's a AAA company, so you are very likely to get your money back. Yeah, you lend them money, they give you interest in return, and in the end of the loan, they will pay you back. And the more secure the company is, the higher their rating is, the more secure you are that you will receive your money back. When you go after lower than BB, then you get into specular bonds, and then you get into what we call junk bonds, and it goes further than that. And to refer to the Greek government, they stopped measuring after the C status of the Greek government. So maybe it was already a D, which means bankrupt. However, they never measured it any lower than C. They just stopped like an ostrich, put your head in the sand, and then you don't know. But anyway, the Greek government recovered. So if you have now a bond with an interest rate of 60%, you're doing a great job, right? Because the interest at the bank is like nothing. I started with the word a marketable IOU. So the principle is somebody takes out a loan and you lend them money and you get interest in return. However, you can sell it on to somebody else. Yeah, so somebody else will get the money back in return. If you would have like the interest bond of the Greek government now with the interest rate of 60%, would you ask like 1,000 euros for it, or would you ask more? You can, maybe somebody has an idea. Would you want to sell it for the nominal value, the value you would get in the end? Feel free to answer or put it in the chat. No, why not? Why don't you, Diana? Yeah, Diana, why don't you want to sell it for 1,000? You think you want to sell it for more or less?
Well, I mean, any kind of investment has this idea that you either gain interest or you save yourself from money depreciating in value. Mm-hmm. So there's some kind of risk. So you get paid out for carrying risk of a value, and you carry the value of being able to get a payout. So I think the nominal value will, in most cases, not necessarily be the true market value of an asset. So it would not make any sense to sell it for that price.
No, that's correct. That's correct. That's the money you invested in it, and that's the money you will get back in the end. However, now these days, now the Greek government is more secure. So the company, as we call the government, is stronger, and you still get 60% interest. That will be a great investment. So therefore, also the law of demand. If people want to have that, you are going to ask a higher price. So therefore, bonds also have a selling price or a certain kind of value. Their quotation is done in percentages, and that's a percentage of the nominal value. For example, a bond ABC will give you a 4% yield a year. It still lasts for 6 years, and the price you have to pay at this moment is 85. That means 85% of the nominal value. On the other end, there's another bond of 8%. That matures in 10 years time. So after 10 years, you will get 1,000 euros, and you have to pay 120% of the nominal value. So which one is more profitable? At first, you will probably say, well, I would like to have 8%. However, you know, after 10 years, you will only get 1,000 euros back. And now you have to pay 120% for it. So you have to pay 1,200 euros in order to get 8% of 1,000 euros. So therefore, what's important is the coupon, the 8%, the maturity date, and the price you have to pay. And those are all put in these yields. And if you look at the market and you think, I want to put my money into bonds because then I get a little income out of it, I get interest income, then always look at the effective yield. Because the effective yield takes into account that you get an interest, the coupon yield. It takes into account that there's a maturity date. So after 6 years, you get the nominal value back. And it also takes into account the price you are going to pay for it. Well, the coupon yield for the first one, you get 40 euros out of 1,000. So that's 4%. That's why it's a 4% bond. However, the current yield takes into account the price you pay. Remember, you get 1,000 euros in the end after 6 years. So every year you get 40 euros, 4% yield. And based on the price you paid for it, 85% of 1,000, makes that you actually, your yield is not 4%, but 4.7%. Because you paid less than the nominal value. On the other end, the 8% bond has a higher coupon, but also a higher price, that means that instead of 8%, that is the yield, it returns to 6%, 6.6%. And if you take into account that in 6 years' time, you will get 100% back. So instead of the 850 you paid, you will get 1,000 euros back. That will probably increase the yield as well. I put it into this one, this slide, separate slides. Price is now 85%. You will be paid back 100%. So that means you will make 150 or 15% profit as well at maturity. So that means that you have a profit of 25 euros a year. That's very good. However, the other one, you are going to get paid back 100%, which is less than what you paid for it. So therefore, you are going to make a loss. And that loss is spread out over this year. And then I always say, this is a very interesting slide if you want to dig in deeper. However, the result is this one. Bond number 1, at first sight, gives you 4% yield. However, if you take into account the maturity date, the price you pay for it, then the effective yield is 7%. So I would rather have bond number 1 than bond number 2, because this one gives a good yield. However, the price is high, and therefore the real yield is lower than expected, than what you'd see at first glance. So with bonds, you get a yield. You have to take into account that you are going to make a profit or a loss in the end when it's paid back. And therefore, you always have to take into account what price am I going to pay for it. So look in the sheets of where you can pick out the bonds, what kind of effective yield the bond really is worth, what kind of yield it will give you. So that's the bonds, but you see they are pretty low in ranking. So the next one in line, with a little bit higher risk and also a higher return, is property. Yeah, in this case, the return is huge, especially in the big cities as Rotterdam and Amsterdam. Even big investment parties stopped investing in property in Amsterdam because they can't make any money out of it. It's too expensive. And when you look at property, you look at house for sale, but also for apartments, shopping areas, shops, offices, etc., etc. That's all part of property. Well, property is good because it's solid. It lasts a long time if it's built properly, and you can rent it out. That will give you a yield, or you can flip it, like buy it, make it a little bit nicer, and then sell it again and have a profit. This is a good investment, and you see a lot of people saying, well, property is a very solid investment. It's a good investment right now. There are also some, I won't say downsides, but things to keep in mind. It will cost you a lot of money. Not only the purchase of property is at a high price these days, but also the cost involved to it. You have to go make it legal, and especially when it's attached to like a big building like that, you have to deal with other persons and legal stuff. So therefore, it will cost you a lot of extra money. Rules, taxes, etc., etc. And also, when you rent it out, you have to deal with tenants. Yeah, and you when they break something in the house, then most of the time you can repair it. So therefore, you always have to deal with other people, and you want, or maybe you will have somebody who will deal with these tenants. But because it's a lot of money, it's very hard to spread out your fortune. For instance, if you have 500,000 euros to invest, well, that will probably give you one apartment in Rotterdam to invest in. So if the housing market drops, the prices go down, well, then your investment loses value. So therefore, spreading out your fortune is very difficult if you invest directly into property. Well, maybe you have 100 million in your pocket, then it's easier to spread out as an apartment, a building, an office, a shop. Then you can spread out a little bit. So therefore, I get back to you, because it is possible with a small amount of money to invest in property, and you do that through pooled investments. I get back to it later on. So we have these three. The next one is, I think, the most accessible one, the one you can well, access the easiestly, and those are shares, or stock, as we call them, shares of companies. And I always ask my students, what is a share? When you have a share, there are two items attached to a share. The first one is that you have a part of the company. Part of the company is yours, even though when you have only one share, that share belongs to you, so therefore you have one part of the company. And when you have one part of the company, that means that you have a right to vote, and that you have a right to have a piece of the profit. And the profit is most of the time dividend. So with bonds, you get interest, and with shares, when companies make a profit, they sometimes give you dividend, a piece of the profit. To be honest, most people don't do it for the right to vote, because even if you have 1,000 shares of a company, still that's a minor piece, and therefore, even if you want to vote, your vote is useless, I won't say, but anyway, not worth that much. And also dividend payouts, well, if a company pays out dividends, then they give away a part of their profit, and that part of the profit is not invested. So why would you want to invest in shares? Well, most people say, I invest in a share and I wait until the price go up and then I sell again. So the idea is buy low and sell high. That's the idea, and there you make a profit. I keep an eye on the time. This time, let me see if I share this screen, and I hope, yes, it's still screen sharing. Okay, this is a view of from July 20 until June 21 until today, the movement of the Dutch stock market, the Amsterdam index, AEX. So that's how it works, how the index works. In the index, there are several companies, and when these companies, their prices go up, the index goes up, and when they go down, the average is the index. And now we can see that let me see, where are we? It's Thursday, not on it. Yes, 734. That means it's pretty high. We're at the top of what we had before. However, you see that there are small movements. They look small, but in the past year, even during the pandemic, we see that the market went up and up and up and up and up. And it started from November. So in November, people got more confident in the economy, and therefore they started buying again. If I go a little bit back, we see where we came from. In February last year, before the pandemic, it was at 629. We all went skiing, we had a nice holiday, and COVID was something that belonged to China. However, then it came to Europe, and you see in March, the stock market fell to 400 and even 404. So more than 200 points. That means that all the companies in that index also lost a lot of value. From 600 to 400, it means that they lost 1/3 of their money. So 1/3 of your money gone in a few days. However, the market climbed again. So therefore, only invest with money you don't need. So that's one item. Let me see. That's one market. The other market also, well, important to, have to find you back. There it is. Also very important, where we always look at, is the Dow Jones index. The Dow Jones index is the stock market of the United States of America, and well, we, the Dutchies, are a little bit a very small market. However, Dow Jones is only 30 companies, 13 companies in that index. They are important. However, the stock market is way bigger than these 30 companies. You can invest in a lot more companies than only on the Dow Jones. The Dow Jones are the top companies there are in the United States on market value. However, all those thousands of companies not on the Dow Jones that are listed on the stock market, you can also invest in. So that about shares. I get back to shares later on, and I will show you some ways of investing in it, because that will give you a better insight. The top of the investment pyramids are reserved for derivatives, and derivatives are something like options or futures or stuff like that. There are rights and obligations to buy or sell the underlying asset, even though you don't have the asset in your pocket. They're used for leverage, they're used for hedging. However, therefore it's in red, don't start with derivatives, because you can make money very quickly, but that also means that you can lose it very quickly. Only when you start to understand the market and you really dig into these options and futures, then you can think of, maybe I should try a little bit of options first. Well, I said I would get back to the pooled investments, because we've had different categories. We had the liquid assets, we had the bonds, we had property, we had shares, and we have derivatives. All these instruments are pulled together in pooled investments. So if you don't have time or to spread out your money in the stock market, or make a combination of bonds and shares, then a pooled investment might be something for you. How does it work? It's an indirect investment. You see here, all people put money in one pot. So it's a participation in a fund. On top of the pile of money, there's a fund manager. And that fund manager has to invest the money in the fund according to the rules of the fund. So if the fund manager has the task to invest your money in the property market in Europe, then he will find the best way of investing all that money that is pooled together from other people and spread it out over property in Europe. It's also possible that he has another assignment. For example, invest in stock, in share worldwide. Then you can, with a little bit of money, even as small as 50 euros or 100 euros, you can invest money in worldwide stocks, and you don't have to pick them yourselves. So most of the time they say it's a reduction of costs, because if you want to invest in China directly, then you have to have an account there, and that's very difficult. to invest there directly. So therefore, an indirect investment in other markets is possible with these pooled investments. If all goes well, the fund manager is a professional and he knows how to spread out the funds in the best way and make a profit. When the price of the fund goes up, the value of the fund goes up. That also means that the value of your invested 50 or 100 euro goes up. Well, you have all these different kinds of things: liquid assets, bonds, shares, property, and derivatives. How do you get started? Well, most people say, well, I want to invest on the stock market. That's the first thing, because stocks are hot at this moment and the stock market is going up. So therefore, I would like to invest in the stock market. Fine. Well, how are you going to pick your stocks? I mean, there are thousands of stocks. And how are you going to make them work for you? Well, there are some things you might want to take a look at. First of all, the news. It's imperative that you follow the news when you are actively investing in stock. Not only the general news, but also company news, market news, and the general news. For example, when there is something happening in China that probably will affect the United States and also indirectly the Netherlands as well. So it goes around the globe. Company news, we are going to have a look at that later on, is also very important. Because when a company says, I'm having problem paying my debts or meeting my obligations, then you will see that the share price will go down. Because if a company is in trouble, nobody wants to have that share. And if you don't want to have that share, you put it on the market. And if there's a lot of shares of that same company on the market, you have to find a buyer. And the buyer will probably ask a lower price if there are so many of the same shares at the market. That's a question of demand and supply. A very high demand will get the price up, and a very high supply will get the price down. So the news, and also general news, there's a pandemic going on. All the share prices went down. There's a financial crisis. Share prices went down, even though there weren't even financial companies. So the news is very important. I also, in the beginning, I asked my students to follow the news and to base their decisions on what to buy or what not to buy on the news. Also important, conflicts in the world or politics. For example, the relationship between USA and China with all the tariffs and stuff like that. The relationship between Russia and the United States, for instance, also has an impact on, well, whether or not companies can buy or sell their products from to and from that country. Environmental issues, also very important. They can also affect the way a company is doing business and therefore the value of that company. And last but not least, the 5 economic indicators. Economic growth, very important. We see that in Europe, there is economic growth again after the shrinkage of last year. Economic growth, and therefore you see people are getting more and more enthusiastic about economy. Everything is going well, so therefore you will see the share prices will rise. Interest, a very important one. I get back to that in the quiz. Currency, well, especially foreign currency, and then I do not mean dollar because a lot of things are paid in dollars. But for example, the yen sometimes has a very fluctuating way of getting around, or even if you have to pay in South African rand or something, then you have to take an eye on the currency. Inflation, very important factor. If the inflation is too high, then probably the central banks will do something to get the inflation down. And also employment or unemployment, what kind of figures you need. If there's a high unemployment figure, then people are not really into investing in certain companies. Yeah, well, where do you get your news? Well, we have Investopedia at Financial Times. I will get to Investopedia first because there's a very accessible website. I'll show you. There it is. Investopedia is very nice for students, but also for other people who want to start with investing. There's even a complete educational part in it. I will give you an explanation on the simulator later, and there's also all the markets are in there. So there's company news, markets news, trading news, political news, trends. You can find a lot over there, and also the popular stocks. Apple, Tesla, Amazon, why not? Yeah, so that's Investopedia, that's one. And the other important one is the Financial Times. They will give you loads of information. And if you have access to it, you have a very detailed on the world or on the US or companies, UK, China, Africa, Europe. So a lot of information can be found on in the Financial Times if you want to have a look at that. So in order to get to invest, one of the things you have to do is follow the news. There it is, etc. Yeah, I still have some time left. I want to do a quick Kahoot with you. I'm still sharing. Yes, play. Teach. I don't know if you ever played a Kahoot before. This is a short quiz. And the idea is to go to Kahoot. Yes. To kahoot.it and then put in the pin 5371666. You can do that on your phone, and then you get in this surrounding. And yes, welcome, Soraya. I will check the news with you. Let's see, okay. Three seconds to one. Yeah, it was Adyen. They were in the news that they received access to the US market. PayPal is already on it. So therefore it's Adyen. The next one, oh, let me see it. RS, very good. You're lonesome at the top, so maybe somebody else can join you. Which oil company claims to be discriminated by? Yes, that was Shell. They said that they are being discriminated because they have to get environmental friendly within a short period of time, and they say, why us and why not the rest of the oil companies as well? I think it's just the tip of the iceberg. The others will probably follow. Okay, RS still on top. Let's see, number 3. Which company ceased production due to a shortage of chips? And I don't mean like the natural or paprika chips you eat, but the chips you put in your phone and stuff like that. Oh wow, it was Samsung. It was in the in the news, and it's not ASML because they are the one producing the chips. An interesting answer is Huawei. No, it's Samsung. So if you're waiting for a new Samsung, maybe you have to wait a little bit longer. Expansion of its global headcount by 100,000 people. It's one of the big 4, as we call them. It was PricewaterhouseCoopers. Probably for most of you a wild guess, a very nice spread in answers. Okay, let's see. Nadia on top. Next. %695 share price rise. That would be nice, right? It was Tesla. Yeah, you probably would have expected Amazon and Zoom because of the pandemic and everybody started to work online and buy online. However, they also had like a rise in the price of about 70% or 70 or 80%. But Tesla, well, that price went through the roof. So if you would have had it, then you probably would have sold it now. Compulsory vaccination for workers looking after people aged over 65. Yeah, Hungary I just made up because I had to think of a country. Russia is making vaccination compulsory for people living in Moscow. At least that's what they are thinking of. It's the UK that say no, everybody who works with older people, older needy people, they should be vaccinated. Hey, there's John B in the top 5. In Brussels, as in the European Union, they want to tighten some rules about energy. What kind of energy should have more legislation, more rules? I can imagine solar energy because there are very big fields and coal is very bad for environment. However, it's the wood burning thing. They are putting extra rules on it, the biomass production. And RS is back where he started at the top, number 8. The Fed is the Federal Reserve, kind of, well, it's not really the central bank of the United States, but they take decisions about increasing or lowering the interest rate. Yeah, the 2 answers right. I put this question in it because today the Fed is going to decide whether or not they're going to increase the interest rate, because when economy goes through the roof, like it's going now, and share prices are going through the roof, central banks, and in the US it is more likely the Federal Reserve, the Fed, can slow down economy a little bit so it doesn't get overheated by using the interest instrument. Then they will increase the interest rate and therefore share prices will go down. However, if they don't increase it, then, well, at this moment, probably the share prices will not be influenced by this decision. However, it also gives out a signal like we are going to support economy, no federal measures, so therefore that could also have a great outcome on the share prices, and it will give them a boost. So therefore 2 right answers. Probably the share prices won't drop. If the Fed increased the interest rate, then they probably will drop. However, they promised not to do it until 2023. So let's see, Cornelis is on his way up. And the last one, a recollection of ventilators. Who was that? Which company was it? There was our own Dutch Philips who had problems with the ventilators, and they saw their share price go down, and they said, well, not that important. So on the 3rd place, it's Nadia. Congratulations. 2nd place, Cornelis. Very good. And 1st place, RB? RS. Oh, great job. Very good. I'm still sharing my screen. Yes. Okay, some last tips, because I see I'm running out of time. Always am. How to avoid pitfalls. First of all, well, you already know that rule. Only invest with money you don't need. Second, you need a long horizon. And a long horizon is like 10 years, 15 years. Then you get into the period of long. So you need to put away your money for a long time. The 3rd one, keep it simple. That means don't invest in things you do not get the hang of. Start simple, like with a couple of shares, or start with a couple of bonds, or start with pooled investments, but keep it simple. Don't do everything at the same time, because then you probably get mixed up or something, or get troubled, or when one thing goes up, why doesn't the other one go up? So keep it simple. And be careful with advice. Well, the Netherlands is full of people who know better. So try to focus your advice, the ways you get your advice, from several different sources, but don't try to read everything. Yeah, so keep your advice to limited to certain people or websites who know or have done already the research for you. And spread out. So do not put everything in Apple, because if Apple goes down, then your money goes down, your investment go down all the way. So try to spread out. And if you choose like Apple, also try to invest in another branch. So maybe a financial assets, or maybe something in production, or maybe something in energy. So spread out your fortune. And then we have to talk about exit strategies, because when you buy something, I always get the question, when are you going to sell? Well, obviously you have to buy it at a low price and then you have to sell it at a high price. But when is the high price? Well, that's for you to decide. So therefore, the easiest way is to set up a strategy for yourself. Well, most people, they buy late and they sell early. However, you don't get any poorer when you do it like this, right? Maybe the price goes up a little bit. Then maybe you were too early, but at least you have safeguarded your profit. I also tell students, when they invest and they see the share price go up, it will be profit once you've cashed it. Before that, it's only like viral money or something. So that's no use to you. It's yours when you've sold the share and you've cashed in your profit. So set your goals, set a target price. I buy it now for 25. When it hits 35, I sell it. Or when I get 25% profit, I will sell it. So that's a very good goal. And yeah, obviously you have to keep your goals. Sell your winners step by step. Maybe you have invested in a company and the price goes through the roof. Is it a good idea to sell everything at the same time? Maybe it's a good idea to sell small portions of that share price. So when the share price goes up, you also have a profit with the ones you still have, but you've also cashed your a part of your profit. So that would be a good idea as well. Sell bleeders at once. When a share price goes down very fast, sell it at once. Don't do it in portions. Just take your losses, put a bandage on the bleeding, and get it over with soon. And then finally, check your portfolio regularly. If you start investing, it's something you have to do continuously, especially when you invest in shares, individual shares, individual companies. If you start to invest in pooled investments, then it might be not necessary to look at it every day, because somebody else is watching your money. All right, make a plan and stick to it. That's the best idea to do it. Make a plan and stick to it. Greed is your enemy. And also something you have to learn by doing is your own risk appetite. I don't know what your risk appetite is. If you don't sleep when your share prices go down, then maybe this is not the right way to make more money. To get the feel of it, I already said, I gave you the website Investopedia. I see my time is up, so I have no more time to show it to you, but go to investopedia.com and you can enter a game, and in that game you can work with 100,000 euros, no dollars, and you can test the market. So you can test how you can buy and sell shares before you actually do it with your own money. And it also gives you a feeling about how you feel when you lose money. All right, so we had a competition with students. Sorry, rankings. competition with students. And this is the one we started in November. And a lot of students probably don't see this anymore. But you see, they started with 100,000 and now their value is 148. So you can, have a go with this. And this is a closed one. So maybe it's very nice to do with your friends who also want to start investing. You can also get into the game that Investopedia.com is doing themselves. Well, I usually have a little bit more time to give you information about the stock market. I hope you have some insights now about how a share and a bond work, and I give you some tips about how to get started. Are there any questions?
Yes, thank you so much, Ploni. I think there were a few questions. Let's see. Daria had a question in the beginning about equity sharing. So what are standard practices? Is it based solely on how you negotiate it, and about comfortable loans, dilutive shares?
Oh, wow. Let's see.
Or Daria, do you want to repeat your question?
Yeah, because I have to read it.
Hello, Nadia, and hello, Ploni. Thank you very much for your presentation.
Hello.
It's really great. Just, yeah, so my question was about equity sharing indeed, but I understand it's a little bit not that suitable for the profile of today's presentation, maybe because it was more about how to invest into stocks and into different options. But for me, the question was that I have a startup and I'm now currently exploring the topic of fundraising. So I'm discussing with some organizations and with investors. So what would be realistic, share of equity in case the company takes a lot of operations, and in case they want to stay independent, what would be the reasonable amount of equity to give to the investor? But I also can imagine that it can be also discussable with each investor. It's case by case. So maybe there's no universal recommendation on that.
No, not by me. No, that's no. I'm sorry, I can't help you with that. Not with a straight answer for that.
I actually got a very useful advice from Bart, who is also the participant, and he recommended the book, which is called Slicing Pie by Mike Moyer. So maybe if also somebody is interested, it's quite an interesting book. I will also take a look.
I think we have to end this session right now since the other one is going to start. But we can continue the questions in the chat, so we can share the links.
Is that possible? Okay.
Yeah, sure.
Okay, because I saw also a question from Kiwi.
Yeah.
I have to read first before I can answer.
Yeah.
I will have to stop sharing. Share. Yes.
Thank you so much, Ploni, for
You're welcome.
this session. It was very interesting. I think many people liked it. And then I think we're going to continue with the next session.